There are so many ways to reach financial freedom that it would be impossible to put all those into a 10 or 20-minute video. Imagine how long it would take to actually figure out all the ways to reach financial freedom. The really great thing I like about investing and reaching financial freedom is that there is no one right way to do it, but there is a one right way for you. And like you, I take in a lot of content from different channels. And I think sometimes watching different people and how they've reached financial freedom and the way that they invest, I don't mimic or copy 100% of anything that one person's done. Nobody had my starting point. Nobody had my resources. Few people have my goals. So what I'm hoping is that people watch my content. They watch Millennial Mike's content, One Rental at a Time's content, Lumberjack Landlord's content, and content like Mazske Finance. I have Marc here with us today, who has graciously agreed to do a live stream with me to answer questions that come up about his journey from, I want to say blue collar worker, right? You were in law enforcement and I think Coast Guard, right? Just active duty.
I was active duty in the Navy.
In the Navy, okay. So right, Navy. I just remember it was on the water, like right. In the Marines, the Navy, we call them Uber. So I knew you were one of those guys. And to where work became completely optional and you didn't have to work until you were 65 or 70 to retire. So I think that's a cool story. I want to say thanks for coming here to share it with us. Can you walk us through the timeline of when you seriously started investing to when you made work optional?
Sure. All right. Well, thanks so much, Dion, for having me back on your channel. I do appreciate it. And I'll try to keep this first part kind of brief, and then we can go into more detail in a bit. But to summarize my investing journey, I actually started investing when I was about 20 or 21 years old, and I was in the Navy, and I started with mutual funds. I didn't know what I was doing, but I was putting a little bit of money into mutual funds. That was the year 1990. 1999, I discovered individual stocks. So I sold my mutual funds and invested strictly in stocks. Around that same time, I found a website that talked about FIRE, Financially Independent, Retire Early. And it would talk about how you save up, say, $1 million, and you got the 4% safe withdrawal rate from the Trinity study. And I was like, wow, I could do that. So going into the 2000s, I invested through the dot-com crash, the Great Recession. And as the years went on, I realized I don't make a lot of money. I'm raising a family. I'm paying my mortgage. I have very little money to put in these stocks. So even though I'm getting a great return, if you don't have a lot of money to start with, it doesn't grow to be that big. And I'm not going to get to $1 million by the time I want to retire. So as I got closer to retirement, I started thinking, maybe I should get a rental property. And this would have been in late 2016. And I was planning to retire from my police job on April 1st of 2018. So when I got that idea and I actually jumped into it, bought my first rental property, I closed on it in January of 2017. I didn't know what I was doing. I had not read a real estate book. I had not watched a YouTube channel. But from January 2017, I almost sunk because I had a really bad experience with that first house and the very first tenant. But I didn't sink. I kept going. The end of the year, I had two. In 2018, I bought a triplex and a little bit in another house. And to fast forward, in 4 short years, I went from 0 properties to 25 properties. And it was just after that I realized, hey, not only am I financially independent, I'm in a position I can pack up and move 1,000 miles away to a much more expensive market. And I think I can survive in that market.
So a couple of quick things. You
Sure.
started with real estate 2016, 2017. And so I kind of had the same idea with stocks. I realized it would take so much money invested to reach financial freedom that it's not that it's a bad path. It's that you really need time, compound interest, and more money invested than you do in real estate. So I went the real estate path too. But in 2016, 17, and 18, I was investing in real estate too. And I remember at that point in time, I was watching BiggerPockets, YouTube channels talking about real estate, Stephan, Minority Mindset. But there was a lot of other channels screaming that the crash is coming. 2008 crash, 2012 prices started going above where they were in 2008. Prices are so high they're unsustainable. 2015 there was the silver tsunami. All of the baby boomers were supposed to start retiring, and there was going to be a massive housing crash. So in 16, there was a whole bunch of people saying don't buy real estate. They remember the crash from 2008 and prices were so high again. What made you get past the fear that everyone has today? So much content is saying, look, interest rates are so high and prices are so high. Don't buy, wait for the crash, wait for the correction. Like we see that over and over and over. And sometimes people that watch my channel, watch those channels, and they kind of think it's a debate. And to me, it's not a debate because I'm buying with rates up, rates down, prices down. It doesn't matter. Kind of like a dollar cost averaging strategy. But when you started, how did you get past all the negativity?
I think I got past all the negativity because I did not realize there was so much negativity. Because I basically just came to the conclusion or the thought, I want to get a rental property. I love the idea of getting another house because my personal residence was paid off. So I had a little bit extra, say, cash flow because I wasn't paying a mortgage. And then this is kind of what there was a final trigger to get me to do it. I was taking vacations in different spots in the South because I was living in Virginia in the Shenandoah Valley. And we went to Savannah, Georgia, and we stayed in an Airbnb. And that Airbnb had 3 living quarters on the property: the big house, the guest house, and a camper, like an RV. And while I was there, the owner was there chatting with me, and I mentioned something about, hey, I'm thinking about getting a rental property. And she was like, hey, do you want to buy this Airbnb? And I started thinking about it. I get back home, I lived, 600 miles away. And it kind of hit me. It's like, wait a second, for my very first property, do I want to buy something all the way down in Savannah when it's an 8 or 10 hour drive and I don't really know what I'm doing? So I didn't buy that one, but that's what got me started to look in the area I was living in to buy that first one.
So you said in about 4 years, you got to 25 rentals.
Right.
What does the financing on that look like?
Like the current financing or how I got started?
To get there, those 4 years, what did those 4 years look like?
Okay. When I was buying that very first house, say I probably found the house in December of 2016 and I closed in 2017. While I was dealing with I was going through a credit union to get the mortgage, and it hit me because the credit union was always sending out these advertisements for a HELOC. And I was always like, I don't want a HELOC. I'm not going to buy a boat or rehab my house, But then I started thinking, I don't have that much money in the bank. If I buy a rental property, it's about $100,000. That's 20% down payment is 20 grand plus closing costs. Say it's $25,000. That would take most of my savings. And I was telling my wife, I was like, I wonder if I could get a very small HELOC because my personal residence is paid off, maybe something like $30,000, something that won't jeopardize me losing my personal residence, but would give me cash to supplement whatever cash I wanted to use. So I did that with the first house. Say, to make it round numbers, say the house, it was $25,000 with down payment and the closing cost. I took probably $17,000 or $18,000 from the HELOC to assist me funding that. All right, so that's how I got that first one. Not to go into detail my traumatic experience with that tenant, but once I got a second tenant in the house and was getting rent checks, I realized a couple things. One, it's like, wait a second, I'm trying to pay that HELOC back and I'm paying like $175 a month towards it, and I'm paying my mortgage, and I'm making maybe $100 positive cash flow after paying the HELOC. But at the same time, I was like, but I have a rental house, and I still hadn't read any books or found BiggerPockets or watched YouTube just yet. But I decided to get a second house in my area. Went through the same process, found another house, This was a distressed house that I knew I could get under market value. I still didn't know about why investors like that, but I knew this sounds pretty cool. It's dirty, but structurally it's sound, and I can buy it under market value. And when I made an offer, my real estate agent got back to me within 5 minutes saying she accepted it. And I initially was like, daggone it, I should have offered lower, because if they accepted that fast, I could have gone lower probably. But I bought it, put in a lot of elbow grease, paid a laborer to help me clean it up and do some basic stuff. So by the time 2017 wrapped up, I had 2 rental properties. All right. I was getting rent checks from the first one. The second one, the first rent check came in January of 2018. All right.
So just like everybody watching, the first year or 2 years are the slowest and feel like everything takes forever. Tell me about the next 2 years.
Sure. 2018, remember I had said I was planning to retire April 1st of 2018. All right. So during my police career, when I was first hired, I did 20 years in law enforcement. So when I was first hired, I started a 457 plan, which is, for those that don't know, it's kind of like a 401k, but it's government workers. And I never had a lot of money to put into it. A lot of times it was $50 a month, maybe $75 a month. But at the end of 25 years, at the end of 20 years, I had about $65,000 in that 457 plan. By January or so of 2018, I guess I had found BiggerPockets by then. And all over BiggerPockets, I was reading about multifamily units. So I contacted my real estate agent and said, hey, are there any, I tried to sound like I knew what I was doing. Are there any duplexes, triplexes, or quadplexes in this area? And she was like, well, we're in a small area, and the folks who own these, for the most part, keep them long-term, but I'll see what I can find for you. So she found a triplex. It was a good building, 2-story, 3 apartments. Each were like 2-bedroom, 1.5 bathrooms, but the building was dirty. It was not very old. It was about 20 years old, but it was like any maintenance was like Band-Aids put on it. It wasn't like correct maintenance wasn't done. But the down payment, it was about $200,000. So $200,000 takes a much larger down payment. But that 457 plan, and with a 457 plan, when you withdraw it, you can be any age at all. If you retire, quit, or get fired, you have access to it, but you got to pay tax, federal tax, state tax. So by the time I paid federal and state tax, I got about $45,000. And that was almost all of my down payment and closing costs to buy that triplex was from that 457 plan. Okay. So that was done. And then the next house in 2018, I also found on BiggerPockets. There was a guy on BiggerPockets that wrote blogs. He was a real estate investor. He was a real estate agent. And he would periodically list houses that he had available in his market, which was Birmingham, Alabama. And I started reading all his blogs and looking at his houses. So I reached out to him, and he sent me some listings. And I was like, I'm not going to say his name on here, but he's a real good guy, though, because I've met him. But I was like, well, let me ask you this. I said, I'm a retired cop. If I buy something from there, I assume you're not going to scam me, because if you scam me, I'm going to go all over BiggerPockets telling everybody you scammed me. And he's like, no, I'm not going to do that. I'm legitimate. Like, all right, I'm going to come down and meet you. So I drove to Birmingham, which was another day's drive away, 600, 800 miles, whatever, 8 hours, 10-hour drive to get there. And I meet the guy. And first of all, I'm like looking up to him. He's a big guy. But he helped me get a house, and it was like $45,000 to buy it. And I was like, whoa, cheap real estate. I didn't realize houses were this cheap somewhere. So when I bought that one, the down payment was much smaller, because 20% of $45,000 is smaller than 20% of $100,000. But again, that down payment, I believe I used 3/4 of my cash and just a little bit of the HELOC money again. So the HELOC was still assisting. All right. And that kind of wrapped up 2018. I had the triplex single family home. So I bought 2 houses in 2017, 4 units in 2018. So after 2 years, I had 6 units in.
So what lender did you use that would lend on a $45,000 house? A lot of people run into the barrier of most lenders won't go below 75,000, and in some cases 100,000.
That one was a local bank in Birmingham.
Okay.
I had an attorney down there, and the attorney knew of a local bank in Birmingham that an out-of-state resident could use. And that's how I got the mortgage, but then it's been sold now to, I think, Wells Fargo, to a big bank.
Almost all the mortgages get sold in a couple of days. And the main reason I ask that is you'll hear people say, you can't or you can never, and it's all lenders are made different. You have credit unions, local banks, mortgage companies. You can find a broker. Like there's all kinds of options to find it. And it doesn't mean you're going to find it every time to make it work, but there are times when it does. Like last year, everyone was saying you can't get a duplex owner occupied for 5% down. They were saying, unless you go FHA, it's going to be more, but there's a bunch of lenders that have been doing 5% down on duplexes. Let me go through these questions really quick here. Howdy to everybody. Lauren, hopefully if you're from Tacoma, you're coming to the Tacoma Phi meetup tomorrow. Brian, Kenny, Dividend Dave, howdy. And then Jay says the market only dropped 1,350 points today. It could have been worse. Right. That reminds me of the time that all of our real estate dropped in one day.
Yeah.
So Jay has a question.
Sure.
And if anybody else has questions, Tuesday afternoons at 4 p.m. Pacific, I do a live stream where I answer all of the questions. But today we're going to get Mazske's opinion. So here's the question. I have an opportunity to buy a 2. So I have an opportunity to buy 3 2s in the 90s each with about 1,100 each in rents. Costs about half. What do you think? So it's so hard to answer that question. I want to put you on the spot because we don't know the market. We don't know what area average rents are. We don't know prices. We don't know what the interest rate on the loans. I mean, I'll let you give your opinion.
Sure. All right. And to make sure I got it right, because I'm not reading the question, he wants to buy 2 houses or 2 properties that are each 3-bedroom, 2-bathroom, and each one priced in the 90s.
Yes, and rents would be about 1,100 each.
Okay. What I would do, and this is what I do with any of my properties, now that I know what I know, it doesn't matter if I'm buying a single family home or I'm buying a multifamily or whatever, I run the numbers and I look at what my purchase price is. I take out principal and interest, taxes and insurance. I subtract usually about 20% for vacancies, repairs, and capital expenditures. I factor in how much I have to pay a property manager and then any other fee I might have to pay. And then I look at what my yield is, my return, my positive cash flow. And if I have a yield that meets my criteria and I have enough positive cash flow, then I'll pursue buying it. And just for back of the napkin calculations, in the markets I buy in, if I was buying in the 90s, those are 3.2, and I knew rents were 1,100. Just knowing that alone, I think it's worth digging into a little bit more.
So it's worth looking into. I'm glad you almost verbatim said what I would say. What's the yield? Whether you're looking at single family, multifamily, whatever, what is the yield going to be? Then you look at, are there economic drivers in the area to support the renters? If someone moves out, are you going to have more renters? Is there multiple economic drivers in case a base or a port or a college or something closes down, or all your tenants going to go away? I don't like to use the 1% rule, where if you're buying it in the 90s but rents are above $900 a month, then you hit the 1% rule, because that doesn't tell you anything about these properties. I didn't look, Jay, if you're in Washington, your property taxes might be $1,000 to $3,000. If you're in New Jersey, they might be $15,000 to $20,000, right? So that's not even factored in there. Do you have a $500 a month HOA or no HOA at all? So like all of those costs, all of those random elements make the 1% rule flawed and outdated. So just like you said, Marc, I would look at the yield and then go, does it check off all the other boxes in my buy box?
No.
And then, so this is a question from Ronald, and I'm going to direct questions towards you today because this is your video.
Okay.
From Ronald. Howdy, Ronald. Are you planning to purchase more rentals or pay off any rental mortgages?
Okay, in my case, tell you what, Ronald, I appreciate that question. And I haven't covered my next 2 years of purchasing real estate or what I've done subsequently. So how about instead of me answering you right now, I'll cover the rest of my story, which will, I think, answer that question for you. And while I'm at it, David and Dave, thanks for watching my channel because I appreciate it. And, all right, so on to the next question, or I can continue my story.
Let's answer the questions, then we'll continue the story, because when the people put the questions in, a lot of time passes sometimes between when they ask it and when we get there. And
Sure.
Not everybody stays for the whole live stream. So are you currently adding properties or paying off mortgages?
I am currently adding more investments, which include more real estate. And as of yet, I'm not paying properties off. I'm still growing.
Cool. Again, word for word, almost like my answer. I'm going to buy them when I find them. I'm still hunting, and paying mortgages off doesn't make much sense.
Right.
It's fixed rate, low interest debt. If I had 7 or 8%, or I had adjustable rate mortgages, I'd be focusing on refinancing or paying those off. So go ahead and finish up the next 2 years.
Sure. All right. So that brings us up to 2019. When 2019 kicked off, by that time I had read BiggerPockets. I had found other YouTube channels. And one thing I had learned was about self-directed IRAs, because I had never heard of a self-directed IRA. I had Roth IRAs with stocks in them. The more I learned about them and the more I ran the numbers, I realized a couple of things. One, my stock portfolio by the end of 2018, I had averaged an 18% return from 2005 to 2018. So I was averaging 18%, which is, it's pretty good. It's good for stocks. But I realized if you only have a little bit of money, even an 18% return takes a long time to grow. So I knew, since I was not going to, well, I was retired by then, but I wasn't of age to tap into my IRAs because you have to be 59 and a half. I was like, well, if I sell stocks, transfer the money to a self-directed IRA and buy a rental house, then in theory, as long as I keep cash in that IRA for repairs, once I'm of age to retire, every rent check, I can just withdraw the entire check. No tax consequences. Now, with that being said, on my channel, what I'll say sometimes is if you're young and you're thinking about starting a Roth, my personal thoughts are I personally would go into real estate at a young age versus starting the Roth. But if you're older and you already have a Roth and it's in stocks and you have enough to buy a rental property, personally, I like the idea of selling the stocks and putting a rental house inside of your IRA, which is a self-directed IRA. All right. So that was the first one I had done in 2019, the first house I bought, and that was in a totally different market. I had reached out to Michael Zuber. By this time, I had been interviewed by Michael Zuber in 2018, late 2018, and I had his cell phone number, and I texted him one day, and I was like, hey, Mike, I'm thinking about using a turnkey provider for the first time ever. And I named one turnkey provider. I was like, do you know anything about this individual? And he said, no, I don't, but I know of another turnkey provider up in Gary, Indiana, and I can introduce you to him. And I was like, sure, put me in touch. So that house that I bought in the IRA was through a turnkey provider. All right, so I've got that. So by this time, I discovered self-directed IRA and using a turnkey provider. So as 2019 was progressing, I ended up selling the second rental house I had bought, the one I bought that was distressed. I made a little bit of a profit, plus I got my down payment back. So I had enough cash that I bought 4 houses from that turnkey provider. All right, so I sold one and bought 4 more from a turnkey provider up in Gary, Indiana. And then as the year went on, I also found out about, on a different YouTube channel, I found out about 401k loans. My wife was still working. She had a 401k. And I was like, well, this is cool. You can borrow money from the 401k, not withdraw it. You borrow it. I could do the BRRRR strategy because I found out about the BRRRR strategy. And once I refinance it, I'll pay the 401k loan off, and that'll basically be my free house. So I did that. I bought a house back in Birmingham, Alabama for $24,000. It needed a lot of work. I rehabbed it for $22,000. So say about $46,000 all in. I got appraised for $77,000. I refinanced it at $51,500, which basically gave me all the money to pay off the 401k loan, and basically for me to say I got a free house. All right. So by the time 2019 wrapped up, a couple things had happened. I closed out the year with 11 rental units. And also I had found a new lender. That this lender is located in Rochester, New York, and he can provide mortgages in almost every state in the country. And depending on the economy, because the number will change at times, he has given me the cheapest mortgage I've gotten was for a house that cost $40,000. My mortgage was $32,000. And that's the cheapest mortgage I ever got from a financial institution. And it's a bank. It's called Prime Lending. All right. So go ahead.
Really quick, I'll jump into a couple concepts from how you've invested. I want to say thank you to Lauren. You win the prize today. It was a hidden prize that nobody knew about, and I didn't mention it, and I didn't want to until it happened. But Michael Zuber just released the Audible version of his book, 15 Conversations with Real Estate Millionaires. Hopefully the narrator doesn't suck. But Lauren, you have my email. It's in the chat. Reach out to me. I'm gifting you a copy of that, so I will send it to your Audible account. Thank you for the super chat. I appreciate it. It lets YouTube know that my channel is liked by somebody, and maybe they should share it with somebody else. So, Marc, there's two more questions I want to get to, and then I want to be respectful of your time, so we'll probably be wrapping up pretty soon after that. But you've used a lot of strategies that I haven't, right? I have never used a home equity line of credit. It's how my brother reached financial freedom. He'd used it over and over and over and got 10 paid off rentals. I emptied my retirement account to buy a triplex in 2020 when they waived the 10% penalty. I have never sold to 1031. I've never done a lot of the strategy. I have a list of reasons why I wouldn't want to use a Roth or a retirement account to hold a rental, because you don't have the benefits of depreciation. You turn passive income into active income, but it's an option. Like, you had that sitting there and you used it. One thing I like that you said early on in your story was your first tenant was a nightmare. So if somebody's watching right now and you have equity that you can use a home equity line of credit on, or taking out a second mortgage, I wouldn't refinance because your rate will probably be worse right now. But your biggest problems are probably going to happen on your first rental, maybe your second. So on your third or fourth or fifth, borrowing against your retirement account, putting it into a Roth, like Jay asked here how you can put it into a Roth. I'm not sure about putting one into it. I know you can buy one in it. There's a few rules like it. You can't manage it yourself. It has to be managed by a third party. You lose a lot of the benefits of owning real estate, but it uses your retirement account for it. There are people watching that have a lot of those options. And just because I haven't used them, and sometimes I make a video on here's why I wouldn't do this, doesn't mean it's not a good strategy. Doesn't mean it's not working. You reach financial freedom with this. That was the whole point of when I started the video of there's so many ways to reach financial freedom. There is no one right way. Nobody's going to be able to go to a YouTube channel and say, Graham Stephan did this, right? Millennial Mike did this, like step by step, follow the procedures. But to take something from your story, something from my story, something from Zuber's story, put it together for what works for that person, and more people will make work optional. There was a question here I want to go through really quick because we kind of talked about it, and I'm going to have you break it down quickly. So this is from Franzo. Howdy. What formula do you use to make sure a rental purchase is a good investment? I have been thinking monthly payments versus what you can rent it for, but not sure if this is really the best way to think. You said it a bit earlier, but if you can do the concise version of how do you run the numbers on a rental, or how do you determine if it's good? And then I'll follow up with mine. It's as short a version of it as I can.
Okay, sure. And I'll try to be short here. Basically, I use a spreadsheet to make it easier for me, but I've done it also by hand on a piece of paper. I take my purchase price, whatever I buy it for. I look at what the mortgage is with the principal and interest. I look at what taxes are, and I get an insurance quote to find out what the insurance will cost me. If I know the rent, and I'll do easy math here, rent's $1,000, my principal and interest and tax and insurance is $500. So if I didn't know any better, I might say, well, I'm making $500. Mortgage is $500, rent's $1,000. But that's not correct, because I also hold out money for vacancies, repairs, and capital expenditures. I do that no matter if I'm buying a house that was just renovated or not. I still hold that money out, or I separate it. And I hold out roughly 20%, depending on the house. Then I hold out any money that a property manager may charge. Say they charge 10%. That's 10% of that $1,000 rent. So that's $100 right there. So you subtract the mortgage, principal and interest, tax and insurance, money for vacancies, repairs, capital expenditures, property management fee. And if you had any other costs, such as cutting the grass, shoveling snow, snow plowing, whatever, then you subtract that. What's left over is what I call positive cash flow, or the positive return of the yield. All right.
Okay, so for me, there's 3 steps. Math is the first one, just like you're going through right now. Annual profit divided by cost to acquire. So what you're looking at is cash flow. How much are you going to make every month? Minus your expenses. So principal, interest, taxes, insurance, and setting aside for repairs, maintenance, and vacancy. And if you're going to have a property manager, set aside for that too. So what's left is your profit every month. That's cash flow. A lot of people, like you said, make the mistake. How much more than my mortgage is the rent? That's my cash flow. No, you can call it cash flow, but your pure cash flow is what's left after all of those future expenses that are going to happen. So how much did it cost to acquire the property? Because if you make $100 a month on a property, we don't know if that's a good deal or not. You can make $1,000 a month on a property, and it could be a bad deal. What if it cost you $50 billion to make $1,000 a month? That's a bad deal, right? So you have to know the math. Cost to acquire is a few things, though. It's not just your down payment, closing costs, and cost for immediate repairs. How much did it cost to get the place rent ready? So those 3 things put together is your cost to acquire. You can also have things in your cost to acquire, like, and here's a golden nugget. If the previous owner just signed a lease with the tenant for the next year at a low rent, you are bound by that existing lease, because the lease is between tenant and property, not who owns the property. So what I would do in that case is take that lower rent. How much rent do I think I lost compared to what I would want, or what the area average is? Total up the year, add that to my cost to acquire, because it's still possible to find a good deal with the right yield, even if you have low rents for the first year. So there's a lot of those kind of things to factor into the numbers. The numbers tell you what's your return or your yield. The second part of the numbers is you don't know if it's good until you know what an average is for your area. What do most deals get? And the way it works in my area is 80% would lose money. They suck. I would never buy any of them. 20% will make money. And out of those 20, the average is between 6 and 8%. So I hunt for 10s. I want the great deal that's better than the average. The third thing I look for when you're looking at properties like that, because we're determining if it's worth pursuing, we're just talking math. The third thing is, do you want to own there? Like, you can go right now to Gary, Indiana, and buy a house for $20,000, $30,000. That needs $100,000 in work that every investor there, including Marc and Millennial Mike, who have a team in place, they're passed on because it sucked, but it's a low price. And you don't know, do you have a team in place? Do you know the neighborhoods to avoid? Are there enough economic drivers so you have multiple sources of tenants? Like, there's this long string of if-thens on buying a property. Starts with math, and that's what most people focus on. But then you follow it with, would you want to own there? One of the things when I first start out is I wouldn't want to own 5 duplexes on one street. I wouldn't want to own a 10plex in one area, because all of your tenants come from that same area. When I was buying in the beginning, I wanted to make sure my next property was at least 10 miles away, so that I'm drawing tenants from different sources, a form of diversification. So we're not going to get our entire portfolio impacted by something like a company moving away. So I wish it was an easy answer of just saying, here's how I look at a rental, but math, do you want to own there? And then does it reach your goal? You have to know what your end goals are, or what your at least your future goals are on investing, on whether you're going to pursue certain property types or not. Going through to make sure that I'm not missing any of the questions here. Cool. So Marc, I want to say thank you on a random Tuesday for taking about an hour out of your schedule of retired early. And I'm figuring out retired early now has a pretty open schedule, but still a whole bunch of things happen. How can people get a hold of you if they want to find out more about you? You know, like, where's your channel? Do you do live streams? How can they get a hold of you?
Sure. The best way to reach me is probably via my YouTube channel. And I always put my email in the description, but my YouTube channel, it's my name that you see, Mazske Finance. That's the name of the YouTube channel. My email address is mazskefinance@gmail.com. So if anyone reaches out to me, I do my best to respond to every comment I get on my videos and every email that I get. And Dion, it's up to you. I got up to 11 units. In 2020, I added 14 more with a new technique. Do you want me to cover kind of quick?
Cover that.
All right. So when 2020 came along, I had tried different techniques. I figured out different things. I bought a second house in a self-directed IRA. One was mine, one was my spouse's. By that time, I was developing contacts because I learned that if you get into real estate, you need to talk to people. So I had met property managers. I met a variety of different folks. And I had one of my contacts call me and offer me a package of 4 houses. When I looked at the houses, I looked at the numbers. I wanted all 4, but I knew I couldn't afford all 4, so I bought 2. One of them I paid cash for. One of them I got a mortgage for. The mortgage was that cheap mortgage I referenced. House was 40 grand, mortgage was 32 grand. The house I paid cash for was $18,000, and I put $4,000 into it to rehab it. So it's about 22, 23, 24 with closing costs. Because even when you pay cash, you pay closing costs. And I still hold that. Both those houses I still hold because they're cash flowing very well. But by that time, through my property manager, I found a gentleman who was a big dog in real estate. He owned roughly 500 rental units, and he was older, and he wanted to sell his rental properties. And I ended up contacting him, and he told me what his prices were and houses he had available. And I knew to get the money, I had to do something else. I used cashback refinancing. I took my triplex and a single family home. I refinanced both of them, pulled out about $65,000, which now is tax-free money. And with that $65,000, using seller financing, 30-year fixed rate with 20% down and a 15-year balloon, 30-year amortization, but a 15-year balloon, I bought a total of 9 more properties with $65,000. All right. And so when I bought them, I learned about seller financing, the beauty of using seller financing, because you save on a lot of different things. Closing costs in particular, you save on. And then to wrap the year up, because the seller was kind of slow and he drug his feet. So I got a little antsy in there, and I found 2 more houses on the MLS, which I bought off the MLS using the conventional 30-year fixed rate mortgages from Prime Lending. So when I wrapped up approximately December 27th of 2020, I closed the year out with a total of 25 rental units in just under 4 years. And within 3 months after that, not only did I realize I am completely financially independent, but I have, I think, a plan figured out that I can pack up, move 1,000 miles away into a house that is much nicer than the house I owned in Virginia, on the water with a swimming pool, and I can actually live in paradise off my investment income. And that's where I'm at right now.
And I've been down there. I came to visit you. You live in a beautiful area. I think that was a great plan. Something I want to point out is a lot of people can look at this and go, okay, so in 4 years, 25 units, sounds like?
Yes.
Okay. Financial freedom. You combine it with a few other things. You invest in oil commodities. You have a few other things that we're definitely going to have you come back and talk about. But the big growth, that adding all of those units in 2020, it's only been 2 years. But I'm wondering if everybody remembers that that was the year of the eviction moratorium and a pandemic and everyone saying, don't buy properties. Ken McElroy, who recanted later, said there was going to be a 40% drop in the market by the end of the summer of 2020. Michael Zuber verbally made it, never got it accepted, but he made a $10,000 bet to their favorite charity that it wouldn't drop. And you were buying properties. I bought two in 2020 myself, then one in 2021. I wasn't buying 9 like that. I haven't used seller financing or anything. Our goals are a little different. My goal was as much cash flow with the least number of units. So no refinances, no HELOCs, no anything like that. But you're adding your system is going to be more effective than mine, because now that you've hit what's called the income snowball, your assets are kicking off more money than you spend. Your assets are kicking off money that you can then reinvest. So you will grow more now than I will with my strategy. So congratulations. I think you picked a great way of doing it. And I'm hoping that people watching know that there is no one right way. Take something that you're doing, take something that I'm doing, and put it together for what works for you. And I think we will be wrapping up right there. Miss Lauren, is that the same as Lauren? No, it's spelled different. So it's spelled different. But thank you for the super chat. I appreciate that. For a longer live stream today, the day the video is being made, Tuesday, my live stream is at 4 p.m. When are your live streams, Marc, or do you have like a set time for them yet?
I don't really have a set time. I've done a couple, but at the same time, I won't go into detail on this, but I'm still living semi-frugally, and I need to buy a new laptop and a desktop computer, so I do everything on my cell phone. So I'm holding off on additional live streams until I get another piece of technology that I can use.
Fair enough. And it's one of those weird things with YouTube. Kind of like I've had a few people reach out and say, hey, would you please put together a course? Like there's all this information, all these people on, but can you put it chronology, put it in order, break it down to just the things you need to invest? The cheapest I found to put the course together is like $5,000. So I don't want to charge people for those kind of services, but do you want to invest to help people on YouTube? Like that's what you're looking at. You don't need that technology. That technology will help you invest on YouTube. So, yeah, and then a super chat from Miss Lauren here with a question. Thank you for the question. That was what I think I missed. I need to get better at that just in case there is a question that I missed that's attached to one. Looking at tax sales, buying for first time in Pennsylvania. You're in Washington right now, your thoughts. So you live in Washington and you're looking buying tax sales in Pennsylvania. So there's something, okay, for different people, making sure, thank you, Lauren. So do you have boots on the ground in Pennsylvania where the tax sale is happening? And do you understand the risks of tax sales? It's kind of like the Burr Project. It's a very effective strategy to go out and buy a share. My brother purchased one from a sheriff's sale, like literally went to the courthouse steps, stood there, bid on it, won it, gave the cashier's check. But you can find a property that has no water. It's not tied into sewer, doesn't have an approved septic. Like there could be some $20,000, $30,000, $40,000 expenses. So like the Burr method, I don't think tax sales and the Burr method are the best strategy to start with. If you have really good income or you have cash flowing assets that are producing and you have most of the basics down. So you're buying for the first time, which means, do you have your leases? Do you know how to screen tenants? Do you know how to find tenants? Do you know how to advertise your property? Do you have handyman in place? Do you know how to get contractors? Like all of the basics that you kind of want to learn those skills to get them down, and then do something risky like do a Burr project or use a tax sale. And depending on where you're buying, sometimes they don't let inspections of the properties happen before you buy. So you don't know what you're getting into inside. And then maybe you could explain a little bit, Miss Lauren, about why tax sales in Pennsylvania if you're in Washington. Because, oh, you're in an RV. You're in your mobile. Okay. So interesting. but you must have boots on the ground or something in Pennsylvania that makes you feel like confident that that's the place that you should be buying in. Maybe you used to live there, you know the neighborhoods to avoid, the neighborhoods to go for. Have you done any tax sales purchases, Marc?
No, I have not. I've looked at them in the past, but kind of for the reasons you just stated, I steered away at that. I may look at it again in the future, but in the past I steered away from them.
I have a friend who broke even after a year with a tax sale. They purchased it, and the person that was basically being sheriff evicted because they'd lost the property, their family owned the property around it, and the well that supplied water to that place was on the family's property, and they terminated the water service. So this person bought the sheriff's sale, had to sink a well, and then sold it, and after a year basically broke even. I'm sure there's a million stories where everything goes great, and there's probably 10,000 stories where things go wrong. If you have great income or the cash flowing assets to support the mistakes or the surprises that pop up, so maybe not even a mistake, you do everything right, and then you find out you have to do something like a whole new foundation or a well or something. But I don't know about it being the first or second deal. Okay. One more question here from Michelle. I have tried with a house in my neighborhood. It is a tear down and it will be a hazmat thing. Someone bought it for $352,000 and they have to deal with the title mess too. Yeah, so there's a title mess too there. Yeah, that's another thing, Miss Lauren. You're not there to check it out. I'm not saying that. I'm gonna give a hypothetical story. So this is not my brother. This is somebody that just sounds a lot like my brother. For the sheriff's sale, going to the property and basically breaking and entering to go in and look at things might be the thing that gives you the confidence to move forward or not. I'm not saying do that. I'm saying that might be what gave that hypothetical person the courage to do it. And if you're in a different state, I mean, that's not even going and looking at it from outside is not even an option. So, yeah, cool. Well, we're coming up on an hour mark. Thanks again for your time. We'll have to do this again because I want to talk about the other types of investing that you've done, because I've had to be so diversified with property type and tenant type because I don't invest in anything else. No stocks, no crypto, no business, no relationships. So I want to find out from you how those other investments work.
Sure. That sounds good, because all the investments I have currently, I love each one in its own special way. I love rental property and I love my alternative investments as well.
Nice. That's kind of why I want you to come and talk about it, because if you like them, people who watch and like them will get something out of it. If I talked about it, it would be coming from an uneducated point of view, and that doesn't help anybody. So someday I will invest in something else outside of real estate, but not today.
Not today.
Until my next video, thanks for coming to my Dion Talk.